Our next guest says he doesn't know what to expect for the month of August. He's confident we'll be higher between now and the end of the year. Though, of course, he does point to four major headwinds that could stand in the way. Joining us now, Bespoke Investment Group co-founder Paul Hickey here at Post 9. Paul, good to see you.
Hey, good to see you.
I don't think any of us can claim that we know exactly what's going to happen over the next month, but I'm curious, what gives you some confidence based on how the market's behaved, based on the backdrop that the rest of the year likely has an upside bias?
All right, so I think you were just talking about before the disinflation. There's always an excuse. Yeah. I mean, people are always going to bring up excuses. But what we've seen in the market over the last 2 months is let's go back to the lows in October. The rally was on hopes. It was on hopes that inflation would subside. It was on hopes that central banks would become less aggressive. It was on hopes that the economy wouldn't fall apart in the process. The last few weeks, those hopes have become a reality. And so now, like you look outside today in New York, there's not a cloud in the sky. Sentiment on the part of investors, I think in these last 2 weeks, has become very confident that things are going to work out great. So I think in the short term, a reality check or a gut check would be good. And I think in the intro, you mentioned four headwinds. They're headwinds facing the market, but they're but ifs, that I would talk about there.
So in other words, they're not necessarily roadblocks. They're kind of, we have to just get through these potential challenges.
They're the things that I think people are going to bring up and worry about, and then people will.
So you mentioned sentiment. Yes. One of them. Valuation, probably another one.
Well, yes. So valuation, the market's not cheap by any stretch of the imagination. When you go versus interest rates, it's still not cheap and it's less attractive. But when you go back historically, you take the earnings yield of the S&P 500. When you look at different levels of the earnings yield, whether it's higher or lower than the 10-year yield, the forward returns are not that much different. They're very close. So to put all your eggs in one basket on valuation, which is the worst timing tool you can even imagine with respect to the market, I think that's something you just got to keep in mind there when it comes to valuations.
Are you surprised on any level, Paul, that we haven't yet seen even the seeds of a sell-off at this point? Because you mentioned that the rally was all built on hopes. And all of a sudden, okay, we have clarity now. It looks like there's a soft landing here. It seems to me it would be sell the news. I mean, that's what typically happens.
Yeah, so you talk about the lack of a sell-off. Last week, the Dow winning streak, record winning streak. You have the NASDAQ 100, 25% above its 200-day moving average. That doesn't happen very often. You have the S&P 500. You have it overbought, short-term overbought every day since the Friday before Memorial Day. And the NASDAQ, this is the reason for my tie today, because the NASDAQ has been overbought every day since Cinco de Mayo. Nice. So, this is what the kind of market we've seen. It's a one-way market that the market has done very well, and you need to see some sort of gut check, as I was saying before. But when you come to all those mentions into those extreme overbought readings that I mentioned, they don't happen in bear markets. Right. They occur during bull markets. And when you have the NASDAQ 100, 25% above its 200-day moving average in the past, every time it was higher a year later. When you have the NASDAQ 20% above its 200-day moving average, every time higher a year later. And that's like 14 different times during the 1970s.